Explore exactly what it takes to become a successful day trader and the power of consistency from the minds of the trading's elite. This is the Beyond the PDT podcast. Here are your hosts, Bryce, Tuohey, and Matthew Monaco.
Hello traders, and welcome back to the Beyond the PDT podcast. I'm one of your hosts, Matthew Monaco, and in this episode we interview Ricky Analog. Ricky is well known on Twitter and on YouTube for his in-depth fundamental analysis, and he has a great YouTube channel full of free content if you're looking to get started with fundamental analysis, and we highly recommend you check it out. In this episode, Ricky explains how he uses fundamental analysis, the best ways to get started, and what he looks for in the morning before he takes a trade, and also in the evening if a stock closes strong, how he dives deep into the filings, and what exactly he is looking for. Despite looking so much into fundamentals and being well known as a fundamental trader, he only bases, he says, 10% of his trades on fundamental analysis. The other 90% of his trades are still based on technicals. He explains why this is his mindset a lot in this episode and also drops a lot of knowledge bombs. So make sure you listen to the entire thing and find out why sometimes fundamentals may not necessarily be the answer. Let's dive right into episode 14 with Ricky Analog.
So Ricky, how's your month of May been so far? Just in general, like trading life?
It's a bit slow as far as like what I typically look for setups. But, I mean, I still find things to trade mostly just because I'm, I trade everything from the bigger names to the micros. So I still find trades, especially during earnings season. So, like, we just kind of came out of earnings, which there's never a boring earnings day. In fact, like, I was just trading some earnings after the bell today. So
perfect. Can you tell us a little bit about who you are? How did you get into trading, and just a little bit about your life? I know we listened to a podcast recently. You said you moved out west. Are you still out there?
I am. Live in San Diego. Been out here for almost a year now. Still seems like yesterday, but yeah, I mean, I've lived in a whole lot of places, and I've been trading for 5 years. And so like trading in the West Coast has its own difficulties, one of them being the time zone or whatever. But, I actually started trading when I lived in Hawaii, so I'm used to waking up early, and it's not a big deal for me. So California has worked out pretty well so far.
Yeah, I totally feel that. I just got to we're both from New York, me and Matt, and I just got out to Colorado, and it's still like it's only a 2-hour time difference, but it's still totally weird having like the market open at 7:30 instead of 9:30. So I'm trying to get adjusted to that, but I'm sure it'll come naturally. So can you tell us a little bit about how you got into trading?
Sure. I actually always had an interest in the markets, but obviously I think one of the biggest barriers to entry is capital. And I actually run an online retail business with my business partner. Most people know him as Reezy Resells. We've been doing e-commerce for I think probably about 12 years now or so. It's been quite a while. And that business grew to a point where it was bringing in decent revenue, and we were also having, a lot of it became automated. We had a lot of employees that did most of the workload, so it was pretty hands off for us, and it kind of allowed us to figure out what it was that we wanted to pursue that was more passion oriented. So Reezy went and did social media and kind of like created like a self brand, and I learned the markets. Like I said, I'd always had an interest in it. My degree in college was I got a bachelor's in marketing. So I took some basic finance classes, and I did really like it. But, like when I actually started learning about the markets, one of the first books I read was The Intelligent Investor, the Benjamin Graham book. And I think I thought that was what I was going to try to do. And then when I ended up getting involved in the markets, the first trade I took was actually Amazon back in the high 200s. After that, it was during like the pot stock boom, the first one, which was, I want to say 2013, late 2013 or something. And so like we got into that and lost a lot of money really fast. And then that was when I kind of started realizing I needed to learn a lot more. And also realized that like the stuff I had been reading in books like the Benjamin Graham Intelligent Investor and stuff like that was absolutely nothing to do with what I was involved with, which was trading, or definitely having a much shorter term view on the positions I would put on. That was how I got started, and it was a very, very rough start. We blew up the account that me and Reezy kind of had put together for ourselves, and blew up my own personal account as well, and then did pretty much the story you hear from everybody, which is the kind of pick up the pieces, dust yourself off, reassess the situation. And most people, that's either where you quit or you reinvent yourself and try to figure things out.
And so can we go back a little bit before all this started, before you got into trading and maybe before you got into that, the business with your business partner. So right out of college, were you working a normal job, or were you kind of always working for yourself?
Actually, the business that me and Reezy did, the online retail, was what I used to put myself through college. So prior to that, I had a whole line of different jobs growing up. So I think the one I did the longest was pizza delivery. I delivered pizza for about a decade, it seemed like. And I ended up becoming like a manager of a Pizza Hut. And obviously that was definitely not something that was like I pictured myself doing for any amount of time. It was just kind of, being young and kind of figuring out what it was that I did want to do. And then when I started the online retail stuff, it was like, yeah, I am never going to work for somebody else again. And it was kind of been that way ever since.
The retail business, was this like a Amazon fulfillment business or like a reselling thing on eBay?
Yeah, we do probably 95% of our business through Amazon. I mean, we do sell on a whole ton of different marketplaces, but we started on Amazon. And actually, when we started, Amazon and eBay were pretty much the only two marketplaces available. And now there's tons of them. So kind of had to grow and adapt as things have changed. But for the most part, we still do almost, I would say 90 to 95% of our revenues through Amazon.
That's awesome. One thing that we've seen a lot through a lot of the people we've talked through is just the entrepreneurial spirit that all these people have. And I think that's awesome that you had your own Amazon business going on in college.
Yeah, I think if there's one thing that allows somebody to stand a better chance than what the odds are of making it in trading, it is definitely to have some other form of income for at least the foreseeable future, and not feel like you need to make money from trading, because by and large, most people lose money for quite a while before they learn how to make it.
Yeah, I can definitely relate to that. It's tough, but being able to detach yourself from, money just a little bit emotionally and not having the pressure that, you need to trade today or you need to make money today can have a huge impact on your overall trading.
Definitely.
So for you, what was kind of the turning point? Because I know Ricky is huge into fundamentals. You got a great YouTube channel, and I know you're also a moderator over at stocktraders.net. So there's obviously been a huge turnaround in your trading since the initial account that you had where you blew up with your buddy. So what do you attribute to just that massive turnaround?
I think building relationships in the community and bouncing ideas off people. There were some definite key people that played huge influences in my trading. All Day Holds, I think that's what most people know him as on Twitter. His name's JM. He's a good friend, and I've definitely learned a ton from him. And there's some guys over at stocktraders.net that definitely deserve shout outs, like Titus and Goose and Monaco Trader. A lot of these guys have become quite good friends, and when you have these people that have been there, done that, can show you what to do, but also I think more importantly what not to do, things to avoid. You start to kind of piece it together, and I actually, there was definitely different phases I went through. So even though I blew up the early accounts on the pot stock boom, that was like a pattern day trade account. I think we had like 15 grand. It was never over PDT. It was in E-Trade, so we were never shorting anything. It was always just longing these and a lot of them were actually OTC stocks. And it's almost embarrassing to think back to it now compared to where I am at now with my trading. But it's part of what made me who I am now. So there was that phase. But then when I moved through that, I came out and learned how to short. And, I think something a lot of people probably can relate to is you feel like you finally figured it out and you got it all figured out and you try again. And, even though I had made leaps and bounds from like that first E-Trade account to where I was only longing really poor companies, I still found it a huge struggle, and especially to find consistency. So like I would go through like these really nice long runs and then just lose it all on a trade or whatever. And that was like one of those things where it's like you feel like you have it figured out until you get knocked on your ass. And then it was like, oh, I don't have it figured out. So you kind of got to step back again. There was actually like, I never blew up another account after those first ones, but there were definite times when like I had to step back and reassess the situation. And I think I made the turn around it was about 2.5 years in. And so I've only been trading for 5 years. So about halfway through what I've been in was when I started finally seeing some success. And it's still, I mean, you hear it all the time. People say like, trading is extremely difficult. Don't let someone tell you trading is easy, blah, blah, blah. But like, I mean, it's so true, because even when you finally do become profitable, it's a constant struggle. It's a constant fight against emotions. The market is a unique thing. It doesn't give any care about you at all or your situation. Is brutal, and if you get out of pocket, it'll humble you real quick. So I try to always stay in my lane and stay focused and humble, and always be on the lookout for that trade that's gonna give you too much of a setback. So it is one about making profits and making consistent gains, but I think two is just as important as staying on the defensive and constantly being on the lookout for that rogue wave that can really, really set you back. And I think that was the biggest lesson I learned was, it's easy to make money. What the hard part is to learn how to avoid the big losses.
Yeah, and I think that's one of the most important aspects for a new trader is to, again, learn how to avoid those big losses. Because like you said, you can make money here and there and here and there, and then all of a sudden it takes one big loss and your account's done. So now, this is kind of like a two-part question, I guess, but why did you keep going along with trading? You were clearly making money with your other business. You said it was pretty passive income and you were losing money you weren't finding consistency for the first 2.5 years. So was there a point in time during that where you were thinking like maybe trading isn't for me? And obviously you kept going with it. So what was the reason for that?
I think there has been maybe like 2 or 3 times in my trading where I've questioned like, can I keep going or should I keep going? And that question, when I ask it, lasts in my head for all of 5 minutes, because it doesn't take long for me to realize like how passionate I am about it. And like, there's no question. Like, this is what I do. This is what I love to do. And part of me feels like that's something that you need to have, like, because I've seen a ton of people come and go, which is crazy because I've only been doing it for 5 years, right? So for me to see the turnover that I've seen in such a short amount of time, and I always try to think like, what is it that separates me from those people that come and go? And like, one of the things I definitely think it takes is like a deep passion and a drive and a willingness to not take setbacks as permanent, but more just like a learning lesson and use them to grow.
Now you have you're well known for your fundamental analysis. Was it this passion that drove you to, dive deeper into this fundamentals then? Because a lot of new traders kind of avoid those. Yeah,
I avoided them for the longest time. And I think part of it is like technical analysis is, and I don't want to make this sound wrong. I don't mean to say it's easy, because technical analysis isn't super easy, but it is. I think it's easier to teach, maybe is the words I'm looking for, but and there's definitely more information out there on it as well. Whereas like reading SEC filings can be like, one, hard to find anybody that's willing to talk about it. And they purposely use like jargon, like industry jargon, to make it more like lawyer talk, right? So that it's confusing as possible. They don't benefit from more people being able to read it and interpret it. So it's written a certain way, makes it less interesting for a lot of people. A lot of people probably would read 110K and probably pass out halfway through it and go to sleep because they're pretty boring. what got me into it was like one of the first chats I was part of was Spartan Stocks, which it's funny. You guys have like a similar name to Under PDT podcast, which I did their podcast. And one of the guys that runs that, he also is the head moderator over at Spartan Stocks too. So like I knew him, and those guys over there was actually one guy who was a really big influence on me, which was he used to be on Twitter. He's not really anymore. His name's Devin. When he was on Twitter, he was under, I believe, Devonshire. He was the one that, like, it wasn't that he taught me fundamentals, but I knew he knew stuff about them. And, like, I would ask him questions, and he would always give me the most, like, short, almost like asshole answers, right? Like, because he was not going to tell me anything. He wanted me to learn how to figure it out myself. One, because he put the work in to figure it out, which means, you know, like, why should he give that information out for free when he had to do the work? And two, like, he knew, like, if he just tells me it, I'm not going to learn anything. So, and I owe him a huge debt of gratitude for that, because that was what forced me to go in, read the filings. And, you know, he would always tell me, like, read enough of them. And before you know it, they start to make sense and they become a lot easier. And he was right. You know, you read hundreds and thousands of filings, and stuff that used to seem very complex or worded funny, now you just read it and you're like, oh, just another one of these situations. Like, you come across the same things over and over and over, especially with these crappy companies that we're usually doing the reading on. And so there was him. There was a few other influences I had. AIP Trades, James, he's a good friend, and I always looked up to him. Another guy, Vic, that I bounce ideas off of on a daily basis, and he's a fundamental beast. So, yeah, I've had some guys, you know, I've been lucky to call friends that they know their stuff and have helped me to get what I consider like a pretty firm grasp on things. A lot of times we do the research like morning of when you see something gapping up. And so like I'm a human and I make mistakes too. So like there's been plenty of times when like I'll be reading something while I'm still kind of wiping the morning boogers out of my eyes, and I'll miss something or misread something. And so it's always good to have a bunch of friends like that you can bounce things off of, and maybe they'll catch your mistakes or you'll catch theirs.
How much do fundamentals impact your trading decisions today versus technicals? Like, what's the balance there?
So I think most people probably assume that it's pretty heavy on the fundamental side, but it's actually the opposite. I would say 90% of what I do, as far as when I make entries, exits, make all the plans for the trade, it's like 90% tech. There is, you know, that 10% that's fundamentals, which a lot of times is all pre-planned, right? So I do a lot of the digging when I know I'm going to be involved in the trade. So I'm looking for a lot of different things that help me develop the correct bias, hopefully, and also lend to having a stronger conviction in a trade. But once the digging is done, it's all technicals from that point forward. There is kind of a basic format that I have that I use for doing the fundamentals. And, you know, there's two different types of digging for me. There is the quick and dirty, which I do, you know, almost every morning when there's gappers gapping and I need to know just the basics of the company in a 5-minute brief overview, versus like when something closes strong on a day one and I know it's going to be in play the next day, then I do like a deeper dive that night. So if we're just talking about like something gapping up in the morning, there's definitely and it comes with time and practice and experience, but the ability to like tear apart a company in 5 minutes or less, there are some things, you know, that you have to know what you're looking for. And the basics of what I do on your typical turd that's gapping is going to be, one, I want a quick overview of their finances. I need to know, are they strapped for cash? If so, how bad? How long will their cash last them? So, you know, when I go to BAMSEC, usually what I'm actually looking for first is to see what are the most recent filings. So from there, let's say the most recent filing is a 10Q or a 10K, then I know I'm going to have really, really up-to-date financials on the company. So I'm going right to that. But like, let's say the most recent filing is an 8K, that is actually something that is going to be a topic that will affect my trade today. You know, I'll be definitely looking at that first. Or maybe it's a recent shelf that got an effect, and you want to definitely dig into that and see what the situation is behind that registration statement. And so once I see whatever the most recent filing is, I go from there. But it's always the same criteria that I'm covering, whether I start with the financials or if I start with whatever kind of overhead they may have. And so the basics are their financial situation, their cash situation, and that comes from all three of their financial statements: the P&L, the balance sheet, and the statement of cash flows. And from there, I would like to also know all the overhead. What's the most recent overhead? Where's the overhead at that's from the past where maybe people have forgotten about it? Lots of times companies have done pipes, so it's unregistered shares of common or warrants that happened 6 months to a year ago and tend to have been forgotten about by a lot of people. And so thing is, when they issue those shares in the pipe, they're not able to be sold right away. So if you find something 6 months ago in a pipe and all of a sudden there's a fluff PR that morning, you definitely need to go and see if they are now registered shares and can now be sold, because those are like actually what I consider more of the golden chances or the golden opportunities, because more people have forgotten about them. It's not something that, unless you just happen to look 6 months to a year back in the 8Ks and see the pipe, or you see the Form D filed 6 months ago or whatever, it's something that's much more easily overlooked as opposed to a brand new ATM, right, that everybody knows about, or brand new warrants that were just issued a few months ago that were issued in a registered offering. So the things that are kind of easily overlooked tend to be the ones that are the better chances, because I guess less people know about them. I find that when more people know about it and it's something that's more entry-level fundamental analysis, you tend to get the people that are early on the shorts. And I'll tell you, this is why technical analysis is definitely more heavily weighted in my trading than the fundamental. And that is because as long as you know how to trade a stock from the technical side, you can let all those early shorts that don't know anything about technicals, that just learn how to read fundamentals, the ones that come in and say, oh, there's warrants at $4 and the stock's pushing right up into that 4 level, and they just start shorting at 380, 390. And then the stock goes to 450 and they're all panicking. And, you can still be on the sidelines, not even involved in the trade yet, and let all those guys get squeezed out. And then you can walk in and just slaughter the trade because you were being patient due to your technicals. So that is why I definitely put more emphasis on the technical analysis. And, in my opinion, technical analysis will always play out on the near term, whereas the fundamental analysis will play out in the longer term. So if we're talking about a day trade, yes, fundamentals will matter, but the technicals are definitely going to override that. And even more so than the technicals, can always be news. So that's why I always talk about making sure you're following the news or have some sort of news service, because you need to know, I don't care what support resistance level something's butting up against. If news were to come out and you don't know about it, that level is going to get breached in the blink of an eye. And if you don't have the news service, you're not going to know about it. So yeah, so like that is the basis of the quick and dirty, which is, find the financials, find the overhead that may matter today, stuff that's at levels that the stock price may very well hit today. And then you develop your bias and your conviction, and the levels that maybe you should wait for, as opposed to just jumping in ahead of time. And then, you make your game plan from there. You say, okay, well, I found overhead, let's say $4. Now you're saying, well, let's not be getting involved in this stock if it's at 250 and you want to short it at 3. No, there's probably a good chance that if there's an agenda here, you're going to get ran over. So it keeps you safe, but at the same time, that's where your technicals come into play. Now, let's say something closes really strong on day one and, shorts are bent. This is going to be one of those things that most likely, in best case scenario for you as a short, what you should be hoping for is that next day gap up and push even further, because the further something gets extended, the more extreme it gets, the higher chances are that it's going to have that, one, it has meat on the bone for the trade, and two, a higher probability of the reversal coming. So knowing that, you definitely want to go home that night and tear this thing apart and see if there's anything you missed, if there's stuff that needs to have further examination. And so when it comes to that, it's pretty much you're looking for the same stuff you're looking for in the morning, but you have all the time in the world. So what you want to really do is that's when you want to actually get out your spreadsheets and start making sure you know like all the warrants they have, all the derivatives, whether it's convertible preferred shares or convertible debt, maybe convertible promissory notes. And you want to know also not only, so a lot of times say you have a bit outdated financials to go off of, like the latest quarterly filing was maybe 2 months ago, and since then it's ran. So a lot of times, like you may think there's a certain amount of overhead, but you also have to take into account the amount of times it's ran since that last quarterly filing and how many times it's popped up to those levels where that overhead was. And you need to kind of do a volume analysis as well and say, well, how many shares did it trade above those levels? Because you need to kind of guesstimate what they have left, because they're not always going to have the full amount of overhead that they had back when that Q was first filed. So you got to do that. You need to also try to formulate a thesis, and this is something that comes with a little bit of practice. I want to say all, but I'm just going to, just to keep myself safe, I'm going to say most of these junk companies, when they run, 95 to 99% of the time there is an agenda. It's not just because the news was really that good and people are absolutely head over heels for this company and it deserves to have a 300% move, right? There's almost always an agenda. And so your goal as a guy that's doing, or a female that's digging, is to figure out that agenda. Because if you can figure it out and you know what they're doing and what their plan is, you can adjust your plan accordingly. And then, that's how you can really come in with that strong conviction. So what I'll do is I will try to figure out what their game plan is. And there's 100 different ones, and that's where it kind of the experience comes in. And you have to figure out what kind of games are they playing, what magic tricks, as I like to call them, are they trying to pull behind the scenes. So you need to be able to calculate a correct float. I think this is where I kind of got the ideas for some of the videos I did do, was knowing like some people need to know this stuff so they can try to figure these things out on their own. So you need to know the correct float, and you need to also be able to figure out what their correct market value of publicly held shares, or the MVPHS, is. And once you know that, you can start to see like what is possible, what's in the realm of possibility for them, as far as if they are restricted by a baby shelf. If they are is there any way they can get out of it? Is that possibly what their game plan is? Maybe they're just trying to grow the float by, maybe they have an ATM and they're dumping shares to grow the float. And by growing the float, they still get to use that previous 60 days, the highest closing price in the previous 60 days, as in the calculation of the MVPHS. So if they can grow the float, they can grow their MVPHS. So that's like one little trick a lot of these turds play. There's so many of them. I can't really go into all of those right now, but I just want to put an emphasis on, like, when you are doing your research at night, when you have all the time in the world, the game plan switches from just like knowing just the important levels that morning to trying to identify the game plan, and generate a bigger picture idea and thesis on the trade.
Yeah, so I was curious because fundamentals, you don't always know if they're going to be selling those warrants or selling those shares. Is there something you see in the technical side that they're selling those shares?
Well, the thing is that I don't have to know, because what I'm always going to be looking for is, like, you'll never catch me on the front side of something that's going parabolic. So I'm always waiting for that first, at the very least, I'm waiting for the first lower high. And then, to be honest, for best confirmation, you still need a lower low even after that lower high. And so as long as you're doing that, it doesn't matter if they're selling them or not, because you're putting yourself in a position where once you have a lower high, now you have something to risk against, because you have that previous high. So once you have something to risk against, as long as you're using correct risk management and position sizing, even if you're wrong, it's never going to be something that's detrimental, right? So I'm a huge advocate for correct position sizing and risk management. So you have to know where you're risking against. That's why I can't get involved in the front side. If you're shorting something that's just ripping faces, like, what are you really risking against? I mean, if you're saying, well, it's moving like 30 cents, 40 cents in a 5-minute candle or whatever, and therefore I'm going to throw a trade on where I think the top is, and I'm just going to risk 10 cents. And it's like, well, that 10 cents it's an arbitrary number. You just pulled that out of your ass. Whereas, like, if you wait for a lower high and you know the previous high was 20 cents from where you're entering, that's not an arbitrary number. And knowing that your stop is 20 cents away, then that also dictates, one, where can this trade go to make it so your risk reward's good enough to take the trade? And two, how much size do you put on so that if you're proven wrong, it's not something that's going to ruin your day, your week, your month, because it never should. And I always tell people that you should never have a single trade that ruins your whole month or even your whole week. Now, there are trades that will definitely make your day kind of suck, but as long as you stick to the risk management parameters and you have you have a positive expectancy through your strategy, poor risk management is really what's going to end up hurting you in the long run. And like, that doesn't mean, so sometimes rip and parabolic, if there is levels to the left, maybe they're not from the same day, right? So maybe you are trading something that gapped up a week ago and has since come in, but now is having that like secondary dead cat bounce push. You do have those recent levels to the left. So you can now take those trades that are what would appear on an intraday basis to look like you're getting in front side, but you really are risking against something to the left. So you do have levels to risk off, and that's not arbitrary. But if we're talking about day one, nothing's happened in the last few months, and you're just like, this thing's blowing shorts up left and right, and you're still that guy that's trying to pick the top, I got news for you. I mean, you better start filling out job applications, because picking tops is not what's going to give you longevity.
Kind of, so when you first started finding consistency in your trading, you said about 2.5 years ago, had you had a good understanding of fundamentals then, or was this something you kind of built along as you became consistent?
Yeah, I didn't learn until maybe 2 years ago. So like, I definitely didn't know them then when I finally like felt like I had turned that corner. And, it was funny because I still kind of wrote them off. Like I'd have people that I would talk to that would mention certain things. And to me, it just sounded like a foreign language. And I was like, ignored it. So now I'm like, I look back on those days and I'm like, oh my God, I can't believe how naive I was, like how little I knew about something that was actually what I considered quite important. But like, at the same time, I know tons of traders. I mean, lots of really, really good traders that are consistent and make a living, and a really good living doing what we do. And they don't know anything about fundamentals. They don't have any care to know anything about fundamentals. And it's kind of like, everybody needs to find like what works for them and figure out how it fits their persona, because, don't let anybody tell you have to read fundamentals or whatever in order to make a living or find consistency and profitability in trading. My daughter just came home, guys. Say hi to Twitter, Ari.
Hi, Twitter.
That's awesome.
So, there was a long period of time when I didn't know anything about it. And, now that I do, it's weird. It's a double-edged sword, because it actually sometimes inhibits me a little bit, to the point where like I'll get overly biased because I find something or know a company so well. Like RWLK was one that was running today, and it's like, there's such a repeat offender on my list as far as like the things they've done in the past and what I know they've probably got up their sleeves in the future, that it makes it really hard sometimes to get on the long side of one of those trades, even though maybe that might be the right trade at the time. But that's something that, you work on over time. I think I've gotten pretty good at longing a lot of different setups, but I definitely prefer, if I am going long, for it to be like a better company, something like a large cap.
Yeah, and I think something pretty interesting that you mentioned is like, the more you know about something, sometimes the more difficult it makes it. And you hear a lot of successful traders say that just because it puts so much more in your head, like, should I be doing this? Should I be doing this? But now, kind of going back to something you mentioned earlier, you said you play a wide array of stocks, small caps, earnings plays. Do you play or is there like a different emphasis on fundamentals for a micro float that's running versus an actual company you're trading? I'm going to have to assume there is.
Big time. Like, I mean, I don't ever do fundamental research past, like, I'll read balance sheets and I'll read earnings reports and things that, matter more on the large caps, but I'm not digging for red flags per se on things like Twilio or Facebook or stuff like that, So definitely they're different beasts, and I always fall back on the fact that that's why technicals matter so much, because I can still trade. Like today, my big trade today was AMD. Like I had a fade on AMD today that was all 100% off technicals. And, the setup, the way it traded, the targets I set, the entry, the stop, the area I would have stopped is 100% the exact same way I would have traded like an ELTK or whatever it is that I'm trading for the day. Because there's just like an emphasis on knowing the way a stock moves and then knowing the way it trends and where a stock should go versus, and when it should go versus when it's kind of a 50-50 coin flip. So, like as traders, our main job is only putting money on the table when the probabilities are in our favor. And, I think that's one of the things I see so many traders make as a mistake. And that is thinking like, just because a trade could do something, they want to put a trade on. So like you have a thesis and okay, XYZ should go, or you think XYZ can go to 15, it's trading at 14. And you're going to use some like arbitrary stop, like your target's $1 and Twitter says you should have a 2-to-1 risk reward. So you're going to use a 50-cent stop. And you're like, before you know it, you're in a trade and you're like, wait a second, just because it could go to 15 from 14, is there a reason it should? Like, and that's the fundamental difference between playing when the probabilities are in your favor versus a coin flip. And I see so many people taking coin flips all the time.
Do you have any discipline tips for new traders who struggle with that exact scenario?
I'm sure I do if I think about it for a second. Like, I know for a fact, like, there's things I do. First and foremost, you got to have a strategy or a business plan, right? Like, you can't just come to the market and try to wing it every day. So it doesn't necessarily mean you have to, like, the night before, like, identify the stock you'll trade and, like, make a plan for that stock. But you have to know, like, you have to have a strategy that you use to trade consistently. And you have to, I would say, if you can't write your strategy down on a piece of paper, and I mean every single rule that goes along with it for every single scenario, like you have to have contingency plans, like what constitutes like a valid trade versus a non-valid trade. And you got to be able to write it all out, because if you can't write it all out when there's no pressure on, like, how are you going to execute it when the market's running and numbers are flying everywhere? And so like, make sure you have a strategy and that you know every nuance of it. And 2, you got to execute that strategy every single day without, you can't deviate. So a lot of people, and like, this is something that I struggle with to this day, and I think everyone does to an extent. And that is like, especially us people on Twitter, right? Everybody on Twitter sees all their friends posting all their charts that, oh, I made so many thousands of dollars trading whatever today. And you're like, damn, how come I couldn't find any trades today? So like, everybody wants to trade everything. You got to realize that some people trade a different strategy than you, or some people feel more comfortable with a certain situation than you may on something else. So like, you have to be able to kind of tune out the noise. Like, I try not to go on Twitter at all during the market hours, and you have to be able to like stay in your lane, basically. So you know your strategy, don't deviate from it. Don't see somebody else trading whatever and think you need to go trade that too, if it doesn't fit your plan. So like, have your business plan. And then, when you have an idea, so like what we were just talking about, where it's the 50-50 coin flips and you think something could go to 15 from 14, don't take the trade, but still watch it and like take notes. Have like, as long as there's no money on the line, then you're not going to lose. You have only knowledge to gain from it. So, and a lot of times what I think you'll realize is that those coin flips end up going against you, or, like it was completely, even if you had taken it where you wanted to take it, it was going to go against you for quite a while before it turned out you were right. All kinds of stuff can happen. And then you can start to like erase those coin flips and start to like really nail down like the times when the odds are in your favor and you want to actually put real capital on the line, because, you know, your capital is your, as Titus always says, he says, your capital is like your little soldiers. You need your soldiers to go to war. So like you got to protect them. You can't just put them out on the battlefield anytime you feel like you could win a battle. You need to only put your troops in danger when you feel like you have the probabilities in your favor.
That's a great example, I think. Actually, I like that a lot. So going back to strategy a little bit, and you know, how have your strategies kind of developed from when you first started seeing consistency? You know, have you developed a lot more strategies, or have you really just refined the ones that you first started off with?
Yeah, I think so. I've got a few main ones, right? And I'm always trying to learn new things and grow, but at the same time, like I always have my core strategies, which they haven't changed over time. I've just dialed them in more. Like I said, I talk with JM, who's all day holds on Twitter, and like I trade a strategy that he's pretty much developed. I mean, you guys can holler at him if you want to talk to him about that. But there are some other strategies I trade as well. Most of what I do revolves around either catching or reversal, which almost always involves a stock that's getting extended, which, I mean, just by definition is usually these low float turds, which is why I end up learning all the stuff about the filings. It's either catching a reversal on something extended, or I'm joining a trend on something that's strong in one direction or another. It doesn't mean it has to be a long. It could be a fade if something is just in a nice downtrend and has reason to go lower. So typically when I'm joining a trend, it's usually either on an earnings breakout or breakdown, something gapping on a catalyst one way or another. So like as a trader, our best friend is range. Something has to have range in order for us to make money. I can't trade. I mean, some people can do it, like trade a 5-cent range all day long. That is just not what I can do. So I need something that's going to have a high probability of having large range for the day. So usually it's going to have a catalyst, which is either earnings, or if it's a bio, maybe it's some sort of data that came out, or a low float micro cap that's got a hair up its butt and decides it's going to gap up 100% pre-market.
Now, going super basic here, let's assume the listeners are just only know technical analysis. They don't really have any fundamental knowledge at all. You know, how would you recommend they get started? Where would they even look up SEC filings? And then once they pull up those filings, what do they do with them?
There's two places you can find them. You can go to the Edgar SEC website, which aggregates everything, but I use BAMSEC, BAMSEC.com, and they do a really, really good job of like visually laying everything out. So like, because there's different filings for different things. So like, obviously, like you'll have your financial statements and your in the quarterlies and your annual filings. And so like BAMSEC will have those all in one little area. And then like under that, they'll have like all the prospectuses and registration statements, which is where you're going to find all the stuff that pertains to financings or offerings. Like, so everything's got its own little section, which is nice. It's such a good layout visually. It makes things quick and easy to find. It has really strong features, but it's for paid subscription. So like the base, you can use it for free, but there's certain things that are definitely not going to be quite as easy to use. So I think like if you're using the free version, only the first like 3 or 4 filings in each category will not be blurred out. You'll see the date on all of them, but like the headings on them will be blurred out. So like say you're trying to look up old 8Ks, and like there's always a ton of 8Ks, which are just anytime there's like a material development for the company, they have to post an 8K. So like if you can't read the headings, you're just going to be clicking on random ones until you find the one you're looking for. Whereas if you pay for it, which it's not too much, you get all kinds of features. Like you can see everything. You can use the search feature, which allows you to like search keywords, which is super powerful, especially when you're looking up, like once you get more in depth, a lot of the things we're doing is looking up convertibles or any other type of derivative. And it's sometimes really pain in the butt to find when those were originally issued. So like with the search feature, you can do that really quickly. And so like if you're just starting out, you're going to want to, I would say the first place I would start would be with like a 10Q or a 10K. Just start reading those from top to bottom, because that gives you the Q is the quarterly, and it tells you pretty much everything that happened in the company for the financial quarter. So the management overview, like they'll discuss like any type of material developments that the company has had, such as like, let's say they are a biotech, any kind of developments they've had with the trials they may be running. And then you're obviously going to have your financial statements. So you see the balance sheet, the statement of cash flows, the profit and loss statement, things like that. Everything's going to be in your 10Q and your 10K. The 10K is your annual filing, which is much more in depth, a little bit tougher to read, takes a little bit more practice. But those two filings, the Qs and the Ks, or not the Ks, the 10Qs and the 10Ks, will get your feet wet, and they'll get you used to reading some of the jargon we were talking about. And from there, what the neat thing about it is like you'll start reading things, and what I suggest people do is like just anytime you come across a term you don't understand, you Google it. You'd be surprised at how many people ask me so many questions on Twitter, like through DMs or whatever, that are, I just want to send them the link to let me Google that for you, because I didn't ask anybody. Everything's Googleable, if that's even a word, but you can find everything online. So just put in the legwork, look up the words you don't know. And once you like define a term that you didn't know, then that you get that aha moment. And what usually happens is once you learn something new, that kind of like the aha, then you come up with a new question. It always leads to another question, which always leads to another search. And then, it's kind of like a rabbit hole. You go down the rabbit hole, and before you know it, you like find yourself in the registration statements, or you find yourself in the proxy filings, or you find yourself looking at the ownership filings, such as like the 13Ds and the Gs. And before you know it, you're like, wow, okay, now I'm starting to get the hang of this, and you know your way around all the filings, and it just grows from there.
Yeah, great advice. Another great resource, if the listeners don't know, is your YouTube channel. It's got a ton of, super in-depth YouTube videos there on how to break down filings. The float one in particular, I was like, holy shit, like I've been calculating the float wrong my whole life.
Yeah, I think that was actually, it wasn't my first one, but I know that one was definitely sparked from seeing a lot of people put up the wrong numbers on Twitter or whatever. And I was like, dude, it should be something that, like, actually I've been talking with a friend who I think has been building like a code to like do all that stuff automatically. And it surprises me somebody hasn't. If you ask me, it's, the SEC, and the reason we have these filings is so that like there's transparency. And so like us as retail investors are safe and educated and can make like rational investing and trading decisions. But yeah, there's so much stuff that is like, you're like, dude, come on, SEC's not there for us. They're totally not there for us at all, because if they were, there'd be like requirements to like always have an accurate float available for people, or to, like definitely not provide all these loopholes for some of the bad actors in the industry and all this other stuff. So yeah, the float I thought was like an appropriate thing to do, because I thought, people should be able to calculate a correct float. Like I stopped making videos, and I get like mixed feelings about it, because I know like people love them and eat them up, but I always worry like too many people get too focused on the fundamentals. And that kind of just goes back to what we were saying earlier about, like, for me personally, even though I know how to read all these filings and dig up the dirt, like I'm still 90% technicals. So like, I don't want people like watching these videos and being like, oh, I found, like, I think the example I always go back to is Blink, BLNK, when it had the big run, like it may have been almost a year ago. I can't remember. But like everybody and their mom knew that they had warrants at $4.25, and everybody was shorting at like $3.90. And I was like, oh, this is going to end bad. And sure enough, I think it went to like $8. So that's one of those things where it's like, just because there's overhead supply, like there's so much more to it. So yeah, I kind of pulled away from making the videos for a little while, and I've been toying with the idea of kind of getting back to it and possibly putting some new content out. I think I might need to think of some ideas first. Like what I started doing was more just kind of like recapping companies, as opposed to just looking at an aspect of a filing. I have been toying around with the idea of putting some more content out. I feel bad for people that always ask me like, are you going to do more videos? I'm like, yeah, maybe.
So kind of going off of what you've been saying, how you're very technical based and knowing fundamentals is important. What would you recommend for a new trader who is, like you said, it's a lot easier, I guess, quote unquote, to learn technical analysis, but for new traders who are looking to find a strategy, how would you recommend them going about that? Just trial and error, or would you recommend them kind of going into something that's based on their personality? You hear a lot of people saying, or a lot of people that are really impatient, they normally scalp trades, whereas people who are patient normally hold for a little bit longer. But for people who are just kind of getting started into this, what would you recommend for them to find a strategy regarding technical analysis?
Well, one, read books on it and educate yourself on it, because I think when you do, like personally, I know when I used to read everything I could get my hands on, and I still do, but like when I was learning, still very, very rookie, certain strategies and books and concepts spoke to me more than others. So like, I remember one of my favorite books was The Turtle Trader, like the Dennis Richards book about the turtles. And that was all about trend following. And then, that obviously leads to more books because you learn about other stuff in that book. I would say once you kind of like get an idea of what you think you may like, you still got to try it out because it may turn out that you're wrong. So start out small. Like don't be putting too much risk on trades when you're still trying to figure things out. And I tend to recommend people start out with longer time frames. So like, I know you were just mentioning scalping, but like I would honestly recommend people start out with probably swing trading and like trying to figure out like on a daily chart where you think is a good spot to maybe start a trade and putting it on, because one, when you swing trade, you use less size because you're using wider stops. So you're going to put on less size. You're not going to put yourself in a position where you're going to freak out right away and you're not going to watch every single tick. And then see how that goes for you and see if your strategy one is valid. Is your strategy even working? Make sure you record data on everything you can take data on, like every single trade. So like I use TraderView. I also use Excel sheets to track so many other things, and shout out to like All Day Faders on Twitter and like his whole group of friends. Like all those guys are so data driven, and I really admire that. And I used to think that I was pretty data driven until I saw their stuff, and I was like, yeah, I'm probably slack. But I definitely keep data on as much stuff as I can. I review trades and I review weaknesses, I review strengths, and I always try to like refine, figure out what's working, what's not, and try to cut out the stuff that's not and try to focus more on what's working. So like if you're just starting out and you take my advice and try putting on swing positions, then you can analyze them later and it's like, well, is this working? Is it not? If it is, do you like it? Does it fit your personality? And from there, you can kind of just build and add on it. If you want to day trade, I think everybody wants to day trade. They think there's like this allure to it because it's fast and exciting, but I swing trade as well. Sometimes day trading is pretty stressful, and sometimes those swing positions can just add a nice little padding to the wallet. And, especially when the trades work out, you're capturing a much larger piece of the move with much less stress. I recommend people don't just get so caught up in the whole day trading fad. Even though I day trade, it may sound weird me saying that, but it's not for everybody, and you do need to kind of find what works for you.
Absolutely. Yeah. And I think that's important to hear too, because again, everyone wants to be a day trader, but sometimes there's other things that are going to work better for you.
It's called marketing.
Oh yeah, absolutely.
All the day traders market the hell out of it, and so do the brokers, because the brokers benefit from it. So it's kind of like, as much as I'd like to recommend it or say that it's a great thing, you still got to realize like a lot of people lose a lot of money trying their hand at day trading, all thanks to the marketing.
Yeah, what is it, like 90% of traders fail or something like that?
They all come in with they've all seen the Jason Bond YouTube ads or whatever it is, and it's almost always flashy money, fast cars, scantily clad women. And it's like, dude, that should be like your sign to turn and run the other way. But everybody wants to chase that shiny object. And then you try your hands at day trading and you realize that it's absolutely nothing like that. And, I'll argue any day that 90% of traders fail statistic is probably really skewed because, one, most people that just chase shiny objects, like they see like fast cars and stacks of cash, those are the people that like they're going to fail at anything they do because they're in it for the wrong reason. So like once you get rid of them, which is probably 85% of them, now you're left with like the 15% that like have drive and they know how to pick themselves up when they fall down and dust themselves off, and they're like persistent and have good work ethic. Those ones, you know, yes, some of them will fail, but I think those guys, the people that are not just chasing shiny objects, are the ones that are going to have much, much stronger chance of surviving.
Yeah, for sure. And it's like, I mean, like you said, it's like that with anything. A large amount of small businesses fail too, but probably the ones who work the hardest, you know, as with traders, anything you do, the harder you work, the more likely you are to succeed. So you were talking earlier about a lot of, you know, track as much data as you can. And again, that's something that all-day faders and all those guys do really well with and inspire a lot of people to track data. Do you track data, though, on just the stocks that you play, or do you track data on the whole market, anything you see moving?
I track setups. So, like, because there's so many times when I don't have shares to short, like I can't get locates on something, or maybe I just don't get fills on the prices I want. But, like, anytime something sets up so that it's on my radar, that's what I track. And I mean, I do follow the broader market, but I'm the first one to admit that, like, I think most people that talk like they know what's going to happen are full of shit. And, you know, it's better to just be reactionary in this market than it is to try to predict things. So like I trade a lot of large caps. So like AMD or, you know, like the high beta names like Netflix and Square and Amazon and Tesla and all those names, you know, I trade them, but I'm always like, I have, I think 32 charts up at all times. And I always have SPY. I always have the Qs. I always have NQ. I always have ES. I always have, the Dow, all of those broader markets up, because when you trade like the large caps, you got to know how they react to the overall market and the conditions happening. Like today, I think there was news about Moeller or whatever. I mean, I don't know if there's a day that goes by anymore where there isn't news from Trump or Mueller or anybody involved in that sphere. But, you know, they caused the market to jump. And, like, you could be sitting, and I always have the news up, too. That's another thing. Like, if you guys use Thinkorswim, I hope everybody knows this already, but you can log into the Benzinga Squawk chat room, and Charlie calls out the news all day long for free. And like, if you're not listening to the news while you're trading, especially large caps, you are really, really handicapping yourself. So like, there's so many times when like you'll see like SPY and maybe if you're in a large cap trade jump and you won't know what happened. But if you're listening to the news, like this morning, I think while I was in the AMD short, you know, something came out about Mueller saying he was going to resign and talking about his report on all the stuff with Trump, and everything jumped. And it was like, you need to know why is the market jumping at a certain time, and you also need to know when economic numbers are coming out, whether it's the Fed minutes, like the FOMC, or any other type of number that's coming out that's going to affect whatever security you're looking at or trading. Now, obviously, that doesn't matter so much on the micros, but it is a huge part of stuff you need to know when you trade the bigger names.
Yeah, that's pretty cool. I'll definitely have to check that out. Now, to finish wrapping this up, what's next for you? Are you working on anything particular with your trading or perhaps your business? Just what are your future plans?
Well, I mean, I have a family. Like, I got 3 kids. And so, like, we're going to do some traveling. I got my brother's wedding coming up. But when we get back from that, I know we're working on some things over at stocktraders.net. I'm always trying to like just help grow that community. And like I said, I may start making some more YouTube videos. If people listen to this and want that, they can always kick some ideas down. And if I think it sounds like a good idea or something everybody could benefit from, I may start throwing together some more YouTube videos. But other than that, like, I feel like I haven't had a whole lot of balance in my life. So like, I'm really going to try to like focus a little more on myself and my family. And, I mean, obviously I'll still trade every single day because it's what I do for work, but Yeah, I really think I need to have some more me time.
Absolutely. That sounds like a perfect plan. So one last kind of thing, obviously our podcast is geared to help those who are trying to find consistency and, perhaps make it beyond the PDT. For a new trader or a relatively new trader that's underneath the PDT, what would you recommend for them to do? I don't know the situation you started in. If you start after you kind of started finding consistency, if you had an account above the PDT or below, and, we've heard a lot that it's very tough to grow out of the PDT. But, if you're a trader with a few $1,000s, would you recommend waiting and learning until you've got some more money? Or would you recommend them to try to grow their account?
It's kind of tough. You can wait. The markets are always going to be here. And that's part of the thing is people feel like they always need to do something right now. So like maybe by you waiting and like saving up the money, you're already starting to like ingrain that discipline that trading takes to be successful. You're kind of already building that into your DNA. But at the same time, like, smaller accounts do offer the ability to kind of pay your tuition at a lower cost because everybody pays tuition. So like whether you pay 30 grand when you blow up your first account that was over PDT or you blow up $5,000 accounts, as long as you're learning lessons. And I think the thing you can do to give yourself the best chance is just learn a strong focus on risk management and don't start out too big. Like, I don't care what size account you trade. I'm talking about just like how much are you risking per trade. So risk management will have that built into it. So if you say you're trading a $30,000 account, you shouldn't be really risking much more than like 1 or 2% per trade. So, and again, you're going to see things on Twitter that go completely against this because you'll see people that are like trading $5,000 accounts and they're making like $1,000 on a trade, but they were risking $500 to make. So they got 2 to 1, but like at the same time, like if you lose $500 on a $5,000 account, that's a pretty big hit. And it's it doesn't take long to blow up that way. So like you got to do whatever you can to keep yourself in the game long enough to give yourself that chance. For me, it's always been a marathon. So like I'm not concerned day to day. It's always like a focus on your either week to week or even month to month P&L. So like don't stare at your P&L all day. If you have a red day, it's okay. Did you trade well? That's what matters. If as long as you're trading well and you have a strategy that has a positive expectancy, week to week, month to month, you should see slow and steady gains. As you grow your account, then you can kind of raise up the amount you risk per trade and you can go from there. But yeah, risk management is key and discipline and just sticking to your process.
Absolutely. And that's something we've heard a lot of almost every one of our other interviewees tell us: risk management and discipline.
Ton of great advice, both mental psychology advice and also fundamental advice, which, is what I really wanted to get out of this. So it's been great. Can't wait to get it out there.
Awesome, man. Well, thank you guys for the opportunity to chat.
Yeah. Thanks for coming on. It's a huge pleasure. It was really great talking to you.
Hey guys, it's Matt again, and thank you for listening to the entire episode with Ricky Analog. If you have any questions or concerns, hit us up at beyondthepdt.com, and make sure you check out our end of the week episode recap blog post, where we highlight all the important points in the episode and format it in an easy to read way, so that way you can review the episode without having to listen to the whole thing. Thank you for your continued support, and make sure you like and subscribe to Beyond the PDT podcast on whatever platform you are listening to it on. We can't wait to see you guys next week.